Шановні колеги, шановні аспіранти, рада вітати вас на нашій лекції. Хочу познайомити вас з Інною Алексеєвою, яка сьогодні нам прочитає лекцію англійською мовою про інновації та діджиталізацію. Будь ласка, Інна.
Hello, so I'm very glad to meet you here in this virtual environment, and I will speak about digitalization through the ICT innovation. Let me share with you the presentation, because this way it will be easier to follow. Well, actually, what I want to show you, right, this way. Okay, what I want to share with you is are the results, the findings, the main findings of one of the empirical researches that I carried out together with my colleague, Christina Mathas. Well, very, very briefly about me, because I'm not quite sure whether you have this information. I've been working for about 30 years in Spain. I belong to a Spanish university, Universidad de Cantabria. We are in the northern part of Spain. And I'm within the business organization, large department. My focus or my research lines are different, but somehow they are always interconnected. Well, I focus on innovation, like, for example, the example that I'm going to show you. Done entrepreneurship since my previous university where I worked. I was leading the chair focused on the entrepreneurial culture among students, and then gender gap in different environments, for example, in business, but also in entrepreneurship, and also in marketing, because right now at the University of Cantabria, I'm within the specific group of marketing intelligence. So I will speak today about digitalization, and the focus of the approach that I offer you in this case is through the analysis of the impact of different determinants, the different factors, internal or external, on the decision about the investment in innovation in technological companies. Well, briefly, the contextualization is that digitalization is considered as a global trend and the growth engine of any economy worldwide. In different countries, we can find more or less the same pattern. And of course, digitalization is linked to the use of disruptive technology. Well, disruptive technology or new technology, more or less, we will speak about the same. And we will always use the term of new technologies, since the current technologies are building or are helping to create the future technologies that we'll have. So from this point of view, I consider that it would be interesting to focus on the specific analysis on the specific companies. In this case, I selected the technological companies, that is the firms, enterprises, which belong to the ICT sector. ICT, which stands for internet and information and communication technologies. And I focused only on one point, is the proxy of the innovation, which typically is the investment in R&D, in research and development. Well, research and development, and specifically in the ICT sector, is considered to be very critical. And the point is how it is managed. What are the main factors that help to go ahead with this decision, with the innovation in the ICT company, or contrary, the factors which impairs, which hinders the progress of innovation in these companies. Well, I put some information like the background, the literature review, and of course, I'm more than glad to share with you after this presentation the full research. In this case, it was published as the chapter of the book that at the end of the presentation I will show you. Well, when we speak about the technological company, typically innovation is very critical or very particular, because it generates certain impact on productivity, but also on business performance. Let's see what is also mentioned about R&D and technological companies in the literature, generally speaking. Well, at the beginning of this century, Owen and Huang, since they, particularly worked on this topic, they say that it represents a large proportion of all the investment made by technological company. But the point is, the point or different points. It's important to note that there are not so many technological companies which decide to do this investment. And it's true that innovation must be managed through R&D, but specifically in the technological sector, there are different nuances or context or points to be taken into account. Okay. For example, if we see what is according to the recent statistics shown, for example, by the OECD main science and technological indicators, we see that the R&D intensity is different in different regions or in different countries. In this case, for example, this upper line, blue line, it states for Israel, it has been increasing this effort in R&D traditionally, but specifically by the end of the last decade, we can see that it's increased enormously. It's followed by Korea, by the South Korea, not so much by Japan, although they try to lead, but they are more or less on the same level as the United States. And generally speaking, what is shown by the OECD members, by the OECD countries. It's not a very good news. I mean, it's not so much intensity managed by the European companies, by the year 27, which is slightly below of China, and slightly over the Great Britain. But we compare so many countries, 27 in this case, with only one country, which is Great Britain. I mean, generally speaking, it's not very good for Europe, for the European Union, the intensity of R&D, as we can see. And more about the context, about the international context, is the R&D intensity as the percentage of GDP. In the previous case, in this chart, what we saw, was the intensity of the gross domestic expenditure. But in this case, we try to analyze what is the percentage, what is the proportion of the GDP in different countries. So we see that this marked in red, which stands for the European Union, 27, it's quite below of the 3%. And this 3% is extremely important, since in 2015 it was said, agreed worldwide, that this was the threshold below which the intensity in R&D was considered to be poor, and over this is considered to be excellent. So let's see over these 3% which countries are. Not so many. The first one is Israel, which is current with the previous chart, Korea, then Taiwan, and Sweden, for example, Japan, slightly over 3%, although we saw in the previous chart that they were not on the same level as, for example, Israel, but nevertheless, in this effort, what they dedicate from their GDP is quite high, and so on. Not good news for many countries, and specifically for the European Union, which I said previously. Here we see the share of the ICT sector. Now we focus only on the technological companies in business expenditure on innovation as the percentage, what is indicated here, and only from the selected European countries. I included the information since, it was available for certain countries, but not for all of them. The distinction between the ICT manufacturing and ICT services, like, for example, development or consulting. And we see the different proportion and different, proportion or effort applied in terms of innovation in each country. So the leading apparently is Cyprus, but it may be explained because Cyprus is very small, so probably it's not very prominent, right? But the rest, Bulgaria, for example, they try to make this effort. Estonia, historically, they have been making this effort, and they continue in this vein. Ireland entirely focused on ICT manufacturing, and it's not very large proportion as we could imagine. Much higher is, for example, of Austria, both ICT manufacturing and ICT services, and Montenegro, curiously. The Montenegro is extremely prominent, okay? So, and just to show a bit more, and this is the last chart about the total environment, international environment. Here, the European Union, since we said that it was not performing quite well in comparison with the rest of the territories and countries in terms of innovation, right? Well, here we try to differentiate the companies which belong to ICT manufacturing and to ICT services. And by 2017, okay, it was curious because the ICT manufacturing sunk or dropped, and much more it was seen as contribution, okay, in terms of value added for this particular sector, but only for the subsector of services. But from then, 2018 or 2019, and I also, well, compared to 2020 and 2021, and more or less the trend is the same. Right now in Europe, what is much more prominent in terms of value added is for ICT manufacturing, that is building of computers or building of different parts which are necessary, right, for the development of technologies. Well, digitalization and technologies. If we speak about innovation, it sounds very positive and very promising, but it's not like this, especially for technological companies. There are many weak points and drawbacks, like negative sides. It generates some costs. That is the costs which are not seen, but we know that we contributed pretty much, right, on from different companies. Large fluctuation on the level of spending, because it's not the investment from the accounting point of view, it's only spending, it's expenditure. And it's sometimes very difficult to justify that actually it's investment that in the future we will. Knowledge as the output of innovation of any R&D project is intangible. It's only the knowledge, and the knowledge and people are considered to be together. So it's very difficult then to differentiate, and if we lose people, if these human resources leave the company, abandon the company, the knowledge is with them. So again, it's another drawback. It generates additional costs. Not only the sunk cost as shown previously, but also additional costs. And we can observe high marginal cost association to debts, which is also very bad because then we don't have enough financing to support our effort in R&D investment. More drawbacks, negative impact on the company's short-term economic results and liquidity. And it's logical because good results, if we achieve any, will be seen in long term. So it is like in the future, and we need to be prepared to support meanwhile, because the short-term economic performance will be bad and there won't be enough liquidity. So typically the technological companies, and we'll see later why it happens so, try to finance R&D efforts through the liquidity, through cash flow. But it's very hard to support. Investment in other tangible and intangible assets, because we need the infrastructure to go ahead with innovation, which is intangible. Increase in wages. Why so? Because we need to hire specific people, experts, which, the salaries will be high in this case. And high information asymmetry. And we can recall like the typical theorems about the information asymmetry, and they fit here perfectly, because what happens is that technological companies know quite well what they're doing and what will be the final possible result. But they don't disclose this information. Don't disclose because it's against the competitive advantage, and it's also because typically the bank people, let's say, the financing people, won't understand it properly, and if they don't understand properly, they quit, their financing, and so it will be very difficult to continue with the financing, with debt mainly. Possible negative consequences of appliement of R&D investment. Creation of moral hazard problems. Mayers and Mylov will speak about the basic theory for debt management, so won't have enough financing. Especially harmful for long-term debts, slow down the development of information in companies because of their financing. And if we don't have enough money to support R&D projects, we won't, go ahead and won't show good results and progress in these kind of activities. And then it generates financial problems, mainly liquidity uncertainty. Okay, more possible negative consequences. All right. Now, the question after making all this literature review is what makes ICT companies invest more or less in innovation through R&D? And the objective set for this empirical work was to determine the impact generated by different factors on research and development investment made by ICT companies worldwide. Now, the sample that we selected included more than 1,200 companies, but we only chose listed companies because it was the only possibility to get through the specific information recorded by the company. So the companies which are listed on different stocks worldwide is the only possibility to obtain the specific financial and economic information about them. The sample included companies from 22 countries, 14 of which were European, and the complete financial data were taken from 2016 to 2018. It's important to note that this work was published in 2022, all right? So that is why we speak about only this period from 2016 to 2018. Now it should be updated, of course, but this example belongs to the publication which was done in 2022. The database that we used for this work were the S&P Capital IQ for corporate accounting and financial information, World Bank's World Development Indicators, which is open. If you, for example, search for World Bank dataset, you will have this free access, no problem for that. And the same happens with the OECD main science and technological indicators because we needed to include the external factors, and the same for International Monetary Fund to deflate, all the indicators that were obtained from companies. The representation of the regions was the following. More or less half of the countries were European, and the number of European listed companies is only 25%. Just imagine the proportion of other regions and countries that had much more representation. The American ICT firms counted at more or less 25%, slightly more, okay, and Asia Pacific slightly less of 50%, mainly Japan and Korea. Large number of companies from the USA, Japan, and Korea with approximately 20% of the total sample. The ICT sector is comprised by the company codes for manufacturers and communication, and also wholesales and retails and services. And this what allowed us to make to classify all the companies in two big sectors, the manufacturers and services. So for the ICT manufacturing sectors, it was about 50%, 51%, in total 639 firms, which were responsible for components, parts, equipment, but also manufacturing and sale of semiconductors and different devices. And ICT service sector, slightly less of 50%. So in this sense, the sample was quite equilibrated. And the focus was done on the services and development where systems, application, computer software programming, and integrated. The method used in this case was the model estimated by generalized least squares, and it's a linear regression. The basic model is as it is represented here in this slide. So we analyzed as dependent variable R&D made in the last year For us, it was 2018. And it was apparently affected somehow by cash flow, by long-term leverage, which is debt, like the external debt, like, for example, loans obtained from banks, by ROA, which is return on assets. Okay, ROA typically stands for profitability. If the company is profitable, then we can expect that it will be positively affected on R&D. Then trade credit. It's interesting to note, but if the company presents the accounting balance and the trade credit is higher, then probably it will be good positive for R&D investment too. Size of the company, distinguishing between large and small size, as log, for example, although it can be also done by the number of the of employees. The Q de Tobin's Q, it's very particular, and specifically it's important for ICT companies. Why? Because Tobin's Q stands for growth opportunities. If the company has more growth opportunities, it means that it has more opportunities in business. Especially, it's very important for software companies, more for software companies than for manufacturing companies. Just imagine if my company has a higher growth opportunity, then I can ask for more support for my R&D. And actually, the growth opportunity is thanks to innovation, so somehow it should be related. And of course, the R&D investment depends on previous R&D investments made by companies. So for this purpose, we took the information related to 2016 and also 2017. This is about the internal factors, which somehow can generate impact on the decision to carry out R&D projects. What about external factors? They are represented through GDP growth. It depends on not exactly the GDP indicator of the particular year, but on the growth which is related to the previous year, which is expressed in percentage. Then FD inflows means the capital, the money that the country receives in terms or through the foreign direct investment. If the company receives more, we can expect that domestic companies will invest more in R&D. And finally, the third external factor is BERT. BERT is used typically by the OECD. That is why we use this information from the OECD database. And it specifies the business expenditure in R&D. That is, if we focus on technological companies, then we can expect if the technological sector invests more or spends more, generally speaking, in innovation, than technological companies autonomously, individually, will also spend more in R&D. So we will see. I mean, this is the model, and we'll see what is the effect generated by all these factors, distinguishing between significant and non-significant impact. Now, the results that were obtained, well, here we can see the explanation, what I already forwarded. The first group, firm level variables, that is the internal variables, cash flow, long-term debt, profitability, trade credit, size, growth opportunity, Tobin's Q, and fixed investment and R&D expenditures. And the second group, macroeconomic variables, GDP growth, inflows of foreign direct investment, FDI, and business expenditure and R&D. So here more explanation about, well, all these symbols used in the model, which I showed previously. The data processing is performed using the free software R, the previous version of 4.1.1, now it's 4.1.2, okay? And we applied 5 times the model through the equation. So the model 1 represents the general results, findings that I'm going to show now, and the model from 2 to 5 is according to the classification. So we mainly, each model is apparently the same, but on the specific selection of the companies. according to different criteria. For example, the criteria of belonging to sector. We made the difference between the ICT manufacturing companies and ICT sectors, services, okay? Because just to observe whether the findings are different, whether the behavior or the decision-making in these companies is different. The same happens when we try to differentiate companies according to the growth opportunities, the Tobin skew. Less growth opportunities, that is low growth opportunities, versus higher growth opportunities. And GDP spending on R&D, weak and strong, and regions, European regions and non-European countries. So let's see the results. Here we can see the results of the general model, okay? This is on the left part, model A, and we can compare it to the model B according to the sector criteria, manufacturing belonging and services belonging. Let's take a look at the general model. So I put the arrows against the variables, both internal and external, which in this or that way are significant for the decision of the ICT companies to go ahead with R&D investment. That is, for example, cash flow. Cash flow is very significant, but it's negative. What it means is that technological companies with much cash flow don't spend much on R&D. And it's very, very particular for the technological sector, because typically we can find that liquidity, I mean, the cash flow in all the sectors is spent for this kind of activities, because it's very difficult to deal and negotiate with banks for the specific loan, especially in long term, to support R&D activities. Why? Because R&D activities are very uncertain. We're not very sure about the results. We only try to find out something that we can imagine, but it's not always 100% true, okay? So mainly companies try to support their innovation efforts through cash flow, but not technological companies. You see, the sign is negative. Now we will, later I will offer you the possible explanation. What else? Size is significant, but it's positive. That is, the larger the company, the higher the R&D investment by technological company, generally speaking, by all companies. This Q is Tobin skew, that is growth opportunity, and it's also positive besides being significant, okay? It means that those technological companies with higher growth opportunities invest more in R&D. I and Q and K represent the investment, hard investment, like investment in buying machinery, investment in, for example, acquiring facilities and so on, like hard investment, physical investment, capital investment, which are different from innovation investment, right? So this hard investment or tangible investment is negative. That is, technological companies that invest much in capital assets don't invest much in innovation. It's like the opposite relationship which is found. And R&D made in the previous 2 years are very positive. They're very significant, and they're positive to the decision of the current year to invest in R&D. It means that it's the effect is like the engagement. The effect is very strong in those companies which decided in the past to invest in innovation, and they continue, they go ahead, okay? Among the external factors, only GDP growth is relevant and it's positive. So in those countries in which the GDP growth is positive, okay, we can expect that technological companies invest more in innovation. So it's like the favorable environment. And more or less the same patterns are seen when we make this differentiation between ICT manufacturing and ICT service companies. For example, in hard investment, we can see that in manufacturing companies is stronger than in service because it's not significant, and the same happens with size. Size is much more significant for manufacturing ICT companies and not so much for service. The rest of the models of the findings show us the results when we make differentiation between the technological companies according to their growth opportunities, less growth opportunities on the left, and more growth opportunities on the right. And you see that more or less the same variables are repeated, but here we have a new one, the debt, long-term debt, and it's only significant and negative for for those technological companies with low growth opportunities. So, these companies don't use the specific loans for their R&D activities. They don't use it all. All right. Okay. More models, and this classification is done according to the effort made by the countries in R&D. So those companies located in the countries in which the effort is very low, below the 3%, what I explained previously when I will show different charts about the macroeconomic environment or the environment in terms of innovation. So we can find that, for example, the size is very important, the growth opportunities are very important, and investment in hard assets are much more important than for those companies which are located in countries. Well, this is the mistake. It should show more than 3% of investment. That is, generally speaking, in those countries in which there is already much more effort is done in terms of innovation on the level of the country, it's very favorable for technological countries. They don't depend so much on other criteria, like on the other factors which are internal or external. All right. And the last one is according to the regions. The companies located in Europe and the companies located in other regions. And we see some differences, like in terms, for example, of profitability. For European companies, technological companies, it's very important to show profitability. Generally speaking, these companies are profitable, then it will be easier for them to obtain additional support to go ahead with innovation, with R&D. Okay, but for companies located in other regions, non-European regions, it's important the size, it's important the growth opportunities, the fixed investment, for example, which is negatively related both for European and non-European. Well, and in this case, GDP growth. GDP growth is extremely important for the companies located in non-European regions, but it's not significant at all for the companies located in Europe. So, what is the general perception? What can we offer as the possible explanation for the results, the findings shown previously? Digitalization is always challenging, but it's also challenging for technological companies. Digitalization meant through innovation. So in this case, investment in innovation is very risky for any company, in particular for technological company, because it's oriented in long term, it's related to higher costs, much uncertainty and very, very low collateral value, at least shown in short term. And it compromises the company's liquidity and also profitability, okay? For the ICT firms, it's crucial to determine what influences. Okay, so the main findings offers us the following. Cash flow is one of the very critical factors which influences negatively any decision of any technological company to invest in innovation. However, the ICT companies behave differently, allocating their cash flow to other needs or strategies. This is apparently the possible explanation why cash flow is related negatively to the decision of technological companies to invest in R&D. Okay. Long-term debt is generally considered as a specific financial instrument for innovation, but our evidence in this particular empirical study show us is that the only exception is found for ICT companies with low growth opportunities. For these kind of companies, the long-term debt generates a negative impact. But for the rest, it's non-significant. So we don't know actually whether it's related positively or negatively. It may be because, well, technological companies use other kind of sources to finance their R&D activities, probably is through capital, for example, through equity, or through non-alternative financing, which is quite popular recently, maybe well, through business angels, for example, or through venture capital, or well, something similar. Profitability. It's relevant only for European ICT companies. The rest of the companies located in other regions and countries which are not European don't show this dependence on profitability. Trade credit has no effect at all for any company located in any country. So it's not very, it may be very prominent and significant for R&D decisions in other sectors, but not in the technological sector. Firm size has a positive effect, and it's repeated in different models. It's replicated specifically for the ICT manufacturing companies and for those with high growth opportunities, and also for the companies which are located in the countries with weak spending, below the 3% from non-European regions. Investment in fixed assets is curious. I mean, the effect is negative, but because they are overlapped and at the same time they can't be managed. Probably in different moments, yes, and different years. Like, for example, the first year that the companies decide to invest in the infrastructure to go ahead next year or in the following years, for example, with the particular different activities or projects related to innovation, R&D. Okay. So in this case, we can assume that fixed investment is complementary to innovation, okay, and but because they can't occur in the same year. R&D expenditure in the previous 2 years are extremely important, and it's repeated in all the models that we presented. And the country's economic growth can be determinant but because we think that it creates a favorable environment. And actually in the general models like this, but when we try to differentiate, we see that behavior is slightly different. It's only replicated in the ICT manufacturing companies, that is the companies which produce the different devices or infrastructure or equipment, for example, for technological companies which continue using it for other purposes like the service, for example, and the companies with high growth opportunities and the technological companies located in non-European regions. The FT inflows, like the capital which the country receives through the foreign direct investment, may be important, but not for all technological companies. It only increases the R&D investment among the technological companies located in those countries which spend much, generally speaking, over 3% of their GDP in innovation. And finally, BERT, as the private business sector's expenditure, is not significant, doesn't generate any effect. So what we can see, for example, in this or that country, as the sector itself, the business, the private sector invests much in R&D, is not very determinant for the technological companies. So at this point, these companies behave on the very, individual criteria. It's very particular, and they are autonomous in decision making of this kind. And the contribution of this study is that, well, we hope that we offer a better, a wider perspective on the development, especially of the European technological companies, and on their decision to go ahead with innovation through R&D spending or investment. And it might be helpful for shareholders, of course, but also for other stakeholders, like, for example, managing board or suppliers of ICT companies, public administration, of course, because at least, well, in Spain, what we can see, there's much support from different public administration, regional and national, right, for this kind of effort. But the drawback, the main drawback is that it's not appreciated, it's not evaluated as in long term, but only in short term, which is not very good. And of course, there are limitations of this study. This study is empirical, so logically, there is this is the main limitation. It reflects only partially the strategy in terms of innovation applied in technological companies. And for the future studies, we at that moment we suggested that it should be relevant to consider some other data, like, for example, many other criteria, and probably apply a different model. And this is, well, the references, okay? And this is something that we applied in the second study. Well, this is the first study that I've already presented. This is the chapter, okay, which you can find freely in internet, well, in Google Scholar, but also on the website of the editorial, which is Nova Publisher, Nova Science Publisher. The book is called Digitalization and Business on the Road to a Sustainable World. And the chapter which I presented is number 3. It's on page 55, all right? There's the full site. And the second study, which was published at the beginning of this year, 2024, is published in Technological Forecasting and Social Change. This is the paper presented to the journal. Do ICT firms manage R&D differently? Well, we try to analyze the decision-making and R&D investment made by technological companies on firm level and macroeconomic effect. We don't repeat the same study because we apply a different model and we apply slightly different data. Just very, very briefly, okay, this is the abstract. We use the widest sample of well, approximately 15,000 of ICT listed companies from 22 countries. And now we used a very large period of time from 2003 to 2018. Okay, the model is used for dynamic panel data, so the analysis is done differently, and this is a system GMM method. And among the findings, we highlight the following. I'm not going to present like the full description because we don't have much time for that, but I'm more than glad to offer it to you after the presentation for those who are interested in that. So we highlight the following is that, again, cash flow is not very good to finance R&D investments. So you see, it's very robust because we use a different sample, we use a different model, but again, we arrive to the same conclusion that cash flow liquidity is not very good for the ICT companies. For other companies, it may be good, and actually it is good. Debt is not the right source for the R&D funding because the effect is also negative. It's very, very similar to what we showed previously. Probably the ICT companies try to use other, well, different financing sources to support their R&D activities. And they rely much more on growth opportunities. Again, Tobin skew is very important for innovative companies such as technological companies. And they also benefit from the favorable macroeconomic environment. Again, in terms of growth, economic growth, and increased business sector spending on R&D. And here, this is very particular. This is the Barrett, what I explained previously, that it didn't show any effect, but in this case, yes, it was effective. It was, well, important for the decision of R&D, all right? So here's the model, the econometric model, which we use. I explained briefly what variables we use and how they are related, okay? So this is the causal model. We can determine that any of these variables is important and it generates certain effects, significant effect, it's understood, right, on the decision to go ahead with R&D of technological companies. And well, that is all. Let me show you the publications of this work. And with this, I will conclude. Where can I show it? Where can I share? Yes, just a moment. Just a moment. Well, okay. So here's the book. I have the full book. and it includes more than 200 pages. All right, and all right, the paper, full paper with the literature review. Here, the descriptive, for example, information about the sample according to the market orientation, whether, like, for example, the case of Austria or Germany or Israel or Spain, which are considered to be country oriented to the bank financial system, like the preference. But Sweden, for example, or United Kingdom, United States, or Australia are considered to be market-oriented financial systems. And according to this, we also made the classification to see whether the results were different. And here are the results. The general estimation, manufacturing, service, ICT companies, the different results, okay? And according to the ROI, according to the debt, how it's distributed, and so on and so forth, okay? So, and this is all. Well, I tried to explain very, very briefly, and I'm very sorry for for being very speedy, but this because of the time constraint. So if you have any question, more than glad.
Thank you very much. Question, please.
Thank you very much, dear Professor Inna. It's very, very interesting, especially for me, for example, because during a long period of time, we studied this, maybe the same problems, but not for ICT sector, but for all economy of Ukraine. So we also tried to construct models how R&D development depends on different indicators, and we had some problems with statistical data for Ukraine when we try to understand the level of innovation and the level of R&D expenditure, for example, for different firms, because government, Ukrainian government statistics have
not very complete.
Some specific features, and but we also tried to use it, and it was very interesting for me, for example, how you defined value added, for example, for ICT sector using Eurostat data and another very interesting indicators. So thank you for knowledge.
Thank you. Thank you very much. The problem, yes, I totally agree with you in the point that statistics are very tricky, especially external statistics. So it happens frequently, even with World Bank or OECD. You say, okay, I have OECD and I download all the statistics, but they don't continue. Probably, I remember there was one factor which I liked and I tried to use it, but then finally I decided not to do it, but because it was not continued. And it was the particular factor of saying like the level of bankruptcy or corruption, the level of corruption of different countries, because somehow it may be considered very important or relevant. Like what happens if the country is more has higher corruption or lower corruption, right? But it's not like black and white, because it's the scale from 1 to, let's say, 10. But it was only maintained during several years, and they didn't continue with this. And you find it very frequently, or the data are outdated. Why, for example, in this second study, which I presented very briefly, it was published by the beginning of this year, 2024, but the data, the latest data is 2018 in my study. But because I didn't have enough statistical external updated data, which I could use successfsuccessfully. And so, and it's not very good for the study, right? For the results. If you say you're outdated, but it's not, I mean, it's not true, but yes, it's true. So yes, it's just a bit tricky, but I think that it's good to share these results, which are very, very, I mean, they're empirical. We can't generalize it, and we can't say that all like technological companies behave like this, but we can detect some pattern, which is very helpful.
Yes, I agree with you, of course.
Yes. So if you can, if you would like to share, if you like to share with me, any of the results or any of the, concerns, something that you try to research, will be great. We can discuss it.
Okay, thank you. I will think about your proposition.
Yeah. Okay.
Okay, thank you. May I ask you a question? Some technical. Thank you for your report. It's very interesting, and I see in your model there were two variables for the previous years.
Yes, in the logistic regression.
Haven't you tried to build an auto-regression model or something like vector auto-regression model? Or something like panel data?
Yes, you are quite right. Well, there are different models applied to the two studies that I show in the previous, which you say where I use the R&D investment of the previous years. It's regression. It's like the linear regression, okay? And we use the model of the least squares, right? Okay, but I mean, it's auto-regression. It's regression. It's only like it's not causal, but somehow it helps to predict, right? I mean, this sense the logic of the regression. But in the second study, since we used a long period from 2003 to 2018, we applied the data panel. So we used the system GMM, like the generalized moment, right? So this the autoriano in bone, so this the essence. And we applied it with four-legged periods. For the GMM, I used four-legged periods.
Does the results were changed from this regression model?
Not very much, and that was interesting. They were not very, very different, although in the GMM we used some different classification, but just to go ahead, for example, profitability. According to profitability, let's see, well, analyze the companies with which are less profitable and more profitable if their behavior is different. So that was one. Another one, like the orientation to the country's financial system, bank and market financial system, just to find out something different. Besides the previous classification, which we applied exactly the same way, ICT, manufacturing and service, for example, growth opportunity, less growth opportunity, more growth opportunity, and the results were more or less the same, were very, very similar, which is great.
Yeah, that's very interesting. Thank you.
Yes.
Thank you very much.
You're welcome.
Thank you. Question? No question.
After this presentation, I will send you my presentation. I mean, my materials. And if you are particularly interested in the papers or in something, I mean, to look at the results, let me know, and I will also send it to you.
Thank you very much. Thank you.
Mm-hmm.
Thank you.
Lapis.